Has the market finally bottomed for 2025? Friday was personally my best trading day of the year, and it was the best day in the S&P 500. The most green day in 2025. The S&P 500 was up over 2%. NASDAQ was up almost 2.5%. Now, this comes on the heels of the fact that we officially hit a correction the day before on Thursday, March 13th. That was an official 10% down on the S&P 500. Not only that, but Friday was a 90% up day. A 90% upside day is when 90% of the volume occurs on advancing stocks. So this was across the entire New York Stock Exchange. Naturally, this is leading people to question whether this is the bottom here, because all we've really seen recently are these V-shaped corrections that remind us of what happened during the pandemic when the market bottomed in March and really didn't look back. So in this video, I'll obviously analyze the market for you as we've been doing here all year, trying to keep you up to date of my current thoughts based on the data and the type of trading behavior that we are recently seeing. I'm also going to be talking about the actual trade. I will walk you through the actual trade, why I went long on Thursday in preparation for Friday. I'll walk you through the whole trade setup, even though I did post it on X on Thursday, if you were paying attention. And then after the stock market update and the projections of where I think we're going next, I will walk you through some of the individual stocks that we recently bought and some ideas based on current technical analysis of individual equities here. So is this a stock market bottom? Let's get right into it. I've been updating you all throughout this year on what has been going on based on the political news cycle with regards to the Trump administration, as well as the Treasury and the Fed, and where I think stocks were headed, at least during the beginning of the year. I thought that it was very, very plausible that we would get a correction early in the year after the euphoria from the election, from the inauguration, and then obviously the holidays, which we tend to see usually some euphoria there naturally. And we did get a correction there. My target was the 300-day moving average, which would put the S&P 500 almost exactly 10% down from highs. But I'm seeing a lot of news and stats online suggesting that this could be the bottom. Obviously, we have been beaten up so bad this year. This is one of the fastest corrections in history, the fifth fastest correction in history to be exact. So it's only natural after the fifth fastest correction and the fact that we've only seen a couple of green days in the last month that the market wants a reason to be euphoric again, right? It's only natural and obvious. Also, we do have a recent memory from the pandemic where we have had a violent V-shaped correction. Now, that is rather revisionist history because most corrections last an average of 115 days. And besides that one in 2020, what we saw with corrections in 2018, in 2022, we even had a correction in 2023. It wasn't really that quick of a snapback. Even in 2023, when we were bullish, when we turned into a bull market coming out of the bear market, the correction lasted from July all the way until October. So because of the fact that this was the fifth fastest correction in history, I'm seeing a lot of people throw out these stats, these Tom Lee stats here that show, oh man, if it's a fast correction, that means the recovery is fast. Now, while that is true, if you take a look at 2018, which is one of the periods in question here, you can see that the market was green 1 month, 3 months, 6 months, 12 months later, right? But that does not speak to the volatility that we saw in 2018. So if we go to 2018, you can see here that we hit an official correction in February of 08. Right? And then it looks like we snapped back, we came back down to that level, and then we actually had a really nice rally from April all the way until September. But from September to December, we had an almost 20% decline. It was like 19.8. We just avoided a bear market. And so if you look at this February 8th, 2018 to February 8th, 2019, yes, we were slightly up here, right? From this point to this point. But it does not speak to the roller coaster type of volatility that we experienced in 2018. So I think people have this mindset that, oh, if it's a fast correction, that means it's a fast recovery. Really ignoring the fact that on paper, this does not speak to the type of volatility that was experienced in 2018, where we actually did have an opportunity to buy stocks at a much better price than the correction price. More on that later. Now, aside from the fact that we fell into official correction territory, the fifth fastest time in history, we were also at the golden pocket. We're also at the 300-day moving average. As I mentioned to you, the New York Stock Exchange, this was also a 90% day, which is very rare. But how often do 90% days bottom? As a matter of fact, not often at all. So the only time that we went straight up after a 90% day was at the bottom of that 2018 market crash that I told you about, where we just avoided a bear market. That was the only time that we hit a 90% day where we then rallied, and that was the actual bottom. But in 2022, we hit a 90% day. We had a little bit of a snapback and then another bottom. In 2020, we hit a 90% day and then further dropped to form a bottom. In 2015, we had that double dip correction. You can see here the correction in 2011, 2010, obviously the 07 to 08 financial crisis. We had 4 90% days before finally bottoming out when the market tanked over 50% total. So the fact that, people are throwing around this statistic like, oh, it's a 90% day, that means it's the bottom. Actually, that's not what the stats say. It is great, but that's not what the stats say. One other thing, I'm going to pull up the RSI here for a second, right? And I'm going to show you why I don't think that this is the absolute bottom here. If you look at the RSI, we're oversold, right? If you look at every other time that the RSI was oversold in a correction, you could see here, right? We hit an oversold RSI, what looked like a bottom, but then what happened was we made a bottom lower than this before going back to that oversold level, creating divergence between the price, as you can see here, price making a lower low, and the RSI, flat or slightly higher low, right? That right there is divergence. If we go to another correction, you'll see this again in 2022, that correction turned into a bear market. But we had this level off of the 300-day moving average, 10% down, very similar to now, right? We can see here that this is oversold on the RSI, and then we formed another low, thereby creating, once again, divergence where price made a lower low and the RSI made a higher low. And then obviously we had even more correcting to do as this turned into a bear market. 2018, we hit oversold on the RSI. We had a 10% correction, put in a low. And as you can see, just a few weeks later, we made a new low on price and RSI made a higher low. Once again, divergence. RSI making a higher low, price making a lower low. You can see this time and time again. So the fact that we're oversold and that it's a 90% day, I do think we will see a bounce here. I don't think that this is the bottom, as in I do think we are going to make a lower low than this. Now, as I said, it's important to know not to think of these things in such black and white terms. Unfortunately, there are a lot of noobs that come to the channel. That's not the unfortunate part. The unfortunate part is the questioning, right? They just want a binary up or down. And unfortunately, as I showed you, that's not the way the market works. In my view, I think we are going to get a bounce from here leading into the last 2 weeks of March. March typically being one of the most bullish months in the stock market, minus the holiday months or the fall months. But March is actually a typically and historically very bullish month. We'll jump into some stats here in a second. So I do think we are going to get a bounce from here, but unfortunately, price is the biggest informant of sentiment. So I see this all the time. Like price will bounce for a couple of days and people will say, oh man, I missed the bottom. Or then price will tank and they'll be like, oh man, I should have sold, right? They're not looking at trends. They're not looking at analysis. And most importantly, if they're investing, they're not looking at valuations, because regardless of what happens here, I think that there were stocks that were too cheap to pass up. And regardless of whether we fall more or not, which I think will happen, but I'm not Nostradamus, so there is a possibility I'm wrong, obviously. I do think that what's in front of you, you cannot pass up. I mean, the stats on what happens after a correction are so strong, right? So here's what happens after the S&P 500 declines by 10% or more. Almost every single time, a year, 3 years, 5 years later, not only are we green, but we are demonstrably green, right? Or significantly green from that decline. So buying the declines is a much better strategy than buying the highs and then just waiting to get back to all-time highs. If you look here, the S&P returns after a correction, basically the same type of chart, 1 month, 3 months, 6 months, 12 months later. Now, the thing I like about this chart is it does not include bear markets. So this is only corrections of 10%, but less than 20%. How many corrections turn into bear markets? Well, we have that answer. There have been a total of 56 corrections since 1929. Only 22 have morphed into a bear market. So not a singular amount, but most of the time they do not turn into bear markets. So when you look at a stock like Google trading at an 18 forward PE and you look at where the market is at, historically a bounce point here, right? Off of the 300-day moving average minus 10%. If this doesn't turn into a bear market, that is an awesome buy for Google, right? It's an awesome buy regardless. It's just the difference is, do we get more pain or not? And I'm going to tell you why I think eventually we will get more pain, even though I do think we see a violent snapback here going into the March 21st OPEX options expiration. Now, one of the reasons that I think we will see more downside is obviously because the White House time and time again are coming out and telling us we do not care about the stock market. We only care about the bond market. That is it. We need to lower the cost of our debt. Watch my last couple of videos if you want to know what I'm talking about. But the Treasury is definitely trying to get the yields down so that they can actually pay less interest on their debt. The whole mantra of the Trump administration, at least for the first 2 years of this administration, is to get yields down, to slam yields down, to stop bloated spending, to try to do more with less by laying off tons and tons of federal workers. Even just last week, before that monster day on Friday, the White House said that we are in a period of economic transition and that the stock market plunge is not as meaningful as business activity. But I don't work at the White House. I don't work at the Treasury, and I don't work at the Fed, which right now they are not slated to cut rates, right? I don't work at these places, so I don't have insider information. What if Trump comes out, because we know he's mercurial, what if he comes out and says the focus now is back on business? What if he's at odds with Besant? I think that's a low probability, but you know, we've known him to change his mind over the years from the first administration. So what if he comes out and says, screw that, you know, the focus is back on stocks and back on business, right? What if the Fed comes out and does a surprise cut when the market is not expecting the Fed to do a surprise cut? We're going to go parabolic, okay? So if I have an opportunity right now to buy stocks, some of my favorite stocks at valuations that we have not seen in 5 years, I'm going to take it. So my thesis here is that we bounce back. It could be a violent bounce back. Whether we get back to all-time highs or not, certainly it's possible, but it's not currently my base case. I do think we see something closer to 2022 and 2018 where, you know, once we hit that minus 10% threshold at a major moving average, we tend to see a violent bounce back before a new low. Same thing in 2018. We hit exactly that 10% at the 200-day moving average, a violent bounce back before a new low. This is something that I think is more likely, especially with the White House messaging and given the Fed not cutting rates by surprise, right? If they cut rates by surprise, it's a different story. I think that the Fed on March 19th is going to hold rates here. I don't think that the White House is going to change their messaging. Obviously, I'll be tuned in to see the cases for both, but that is my current projection for the market. And now let's jump into the trade. Why did I go long on Thursday for Friday? I'll show you the exact trade that I sent out here. You can see March 13th, 2:47 p.m. I'm currently in East Coast time zone, so that is the market time. But I said SPY officially hit the 300 moving average, the daily fair value gap, and the golden pocket. Going to take SPY calls here with a tight stop for a bounce off this level. I'm buying the April 17th 555 call, tight stop below 544 on the SPY. And it was this exact setup here. And the fact that, as I showed you in 2018 and 2022, we bounced after hitting that minus 10% exactly off of a moving average. This is the daily fair value gap here that you can see me draw out. And in terms of the Fibonacci, it's taking into account this low and this high. We are at the 0.618 of that move down, right? So a perfect confluence here. My best swing trading day of the entire year. That same day, I also took longs on Nvidia. I bought the 115 call because of the setup that it formed here. Actually, Nvidia set up before the SPY did. But you can see here that we broke structure, came back to retest it, to retest this breaker here, and I took longs on Nvidia. So both Nvidia and the SPY ended up playing out very nicely, and we banked on that on Friday. You can see here the SPY calls ran up 25%, the Nvidia calls ran up 32%, and the TQQQ calls, I took those. I did not alert those. That was just a personal trade. Ran up to almost 55%. So just an amazing day on Friday. If you have any questions about the trade from a technical standpoint, leave it in the comments below and I'll respond to you. This, at the end of the day, is an education channel, and I want to make sure that you get the most out of these videos. If you want to trade live with me every single day and you want my day trades, I day trade futures every day at market open, and I also swing trade options, as well as the long-term analysis and my long-term stock buys. Link is in the description below. Come and join the best group on the internet. We are the most comprehensive group covering day trading, swing trading, as well as long-term investing. I believe in my heart of hearts, nobody can cover these three topics collectively like we can. So come and join, and let's get right into the analysis of individual stocks, what I bought and what I'm looking at currently. All right, so if we look at Tesla here, I bought Tesla twice in this last month at the 200-day moving average, and then you guys know my ultimate gap fill was that 220 gap here. I don't think that this is the bottom for Tesla. I think it could be close to the bottom. There is a chance that Tesla does drop back down. Whether it drops below 220 or not, there isn't really a significant target here besides this low that we see here at 182. That certainly is possible. Like I said, Tesla does tend to bottom out April-May timeframe. So it really depends on what the broader market is doing. And honestly, this could create a pretty ugly head and shoulders here that you see here, right? This is a very real possibility. Still not formed yet, so I'm going to reserve judgment, but it's not out of the realm of possibility to see. It's definitely plausible that we create a head and shoulders here. And if that's the case, then we drop down to that 150. And really the distance between the head and the neckline is so far that if we did form a head and shoulders there, the real target would plausibly be lower than 182. So I'm going to reserve judgment for now. I do like where our buys are at. I'm not looking to add more Tesla. Only if it gets below 180 will I justify adding more Tesla here. Otherwise, I am pretty happy with the position that we've currently built, and I'm glad that we stayed patient here. Now, I will say that in a bull market, it is not usual for a stock to be below all three major moving averages. There is the occasional wick below the 300-day, but it's not normal to be below all three major moving averages, the 100, 200, and 300, and then just continue up. We don't typically see that in bull markets, especially on Tesla. You can see Tesla here. Usually, it tends to get pinned to these moving averages and go above it, right? Once we start dropping like this sloppily below the moving averages, we tend to see bigger corrections on Tesla. So I definitely don't like that. There is a shot that we get rejected from here. Currently, I'm not taking a short-term trade just yet on Tesla. I do think that it is in a position to hedge. I did send out covered calls on Tesla because of this monster price action that we've had in the last week. But right now, for me, it's a wait and see game for Tesla. Nvidia looks super bullish here, tagging just below the 300-day moving average. This is the same thing that I was talking about with Tesla, that, if we get just a day or two below the moving average, it's plausible you see a V-shaped snapback. But this kind of sloppy delivery below all three major moving averages is not a good sign. So Nvidia, we did long it. I did end up closing that long on Friday. I do have runners because I do think that this trend line here is something that is very plausible to get tested on Nvidia. So that 135, 136 level, I would not be surprised if this got tested, but I don't have the confidence in this market here, not until we see another bottom on the SPY, or like I said, a low likelihood of the Treasury, the White House, and or the Fed changing tune. It is likely that we get to that level, but I don't think that we easily get above that, especially not with the rest of the semiconductors. I've mentioned this to you before, and I still might take a short on SOXX, but SOXX here, this is such a bearish type of price action here where we've only seen this in major corrections and bear markets, this type of sloppy weekly trading below the major moving averages. We're starting to see signs of that here. So we definitely need a big snapback on SOXL above the 200 and the 100-day moving average. It's going to be hard to do that in this type of environment, again, unless the messaging changes. But right now, I don't think semiconductors are in a great place at the moment. I do think there is value, and I do think some of them should be bought here, like Nvidia at 104 was a steal. But in terms of the broader sense, I don't think we're out of the woods yet. In terms of stocks that I've recently bought, I bought the SPY at the 300-day moving average. I always make a habit of buying the indices minus 10% down or more. And if this turns into a bear market, which is not out of the realm of possibility, I always buy in minus 10% increments. The stats are just too good to pass up on the indices after a minus 10% correction. Whether it turns into a bear market or not, the stats are too good when you look at 1, 3, 5 years in the future. Another one of the stocks that I think look terrible is Microsoft. Microsoft, again, is one of the stalwarts of the US stock market. Look at Microsoft. Look at this price action here going all the way back to 2012, bouncing like a boss off the major moving averages. When Microsoft starts falling like this below all three major moving averages, this is not a good sign and usually coincides with a larger drop in the market. It's no secret I also bought some Google, which I think is the most undervalued stock in the market right now. I bought a little bit of Amazon and I bought Nvidia as well, all three at major moving averages. You can see Google here sitting at the 300-day moving average. I do have a buy set up in the 140s because I do think that there is a chance that we get there. I bought Nvidia at the 300-day moving average. I mean, these are pretty standard buys, but even if you look at the valuations, you can see they're trading at the cheapest forward multiples that they have in a long time. And I bought some Amazon at the 300-day as well. Now, in terms of short-term plays, because I don't trust anything in this market, and this market is so beholden to what comes out of the White House Twitter account, it's really hard to hold multi-day positions here. So I close most of that SPY long. I close most of that Nvidia long. I do have a couple of runners, but nothing compared to the position size I was originally in. If we get to fill this gap here on the SPY, if we get to fill this gap here at the 200-day moving average, depending on what goes on, I am contemplating taking another short in the market. Now, again, depending on different factors, depending on the news, depending on what the Fed does on March 19th, depending on how price is moving, depending on volume, depending on advanced decline, etc., I am going to likely take a short at some point, undecided yet when that is, whether that'll be at this volume imbalance here or whether it will be at the golden pocket of this move right here, which would put us closer to the 100-day. Undecided yet. Obviously, if you're in the Discord, I'll send out the alert in real time. But that is what I'm looking at currently in terms of a short-term play. I don't currently have many short-term plays here. I did talk to you guys about potentially shorting Meta to get to the 200-day moving average. I still think Meta gets to the 200-day. I just need a better short setup. And if Nvidia does get to this trend line, I will contemplate a short as well, but I'm not pre-planning it right now. Obviously, all eyes are going to be on the Fed funds rate on March 19th. This is when the Fed is going to decide whether to cut or keep rates as is. Right now, there's a 98% chance to keep rates as is, and that's because the unemployment numbers have come out really well. But I think that obviously because the GDP numbers are not in, all we have is this GDP now estimate, which shows that the GDP is contracting at a minus 2.4% rate. In April, we are going to get the actual GDP reading as opposed to these estimates. And at that point, depending on where unemployment is, I think the Fed will likely cut starting in May. That's when we will likely get our first cut, unless the GDP numbers completely come out surprisingly good and the unemployment numbers are lower than expected. Otherwise, I do think that the Fed is going to cut in May. I don't think they're going to cut in March, right? Now, if they do end up cutting in March, it will be an absolute surprise, and that will shock the markets. And we will see a huge move if that's the case, but I don't think that's going to happen. So in summary, I personally do not think this is the bottom, regardless of what people are saying. I do think that we could see a snapback, a short rally, and put in another bottom in the market lower than this low here. I think the White House and the Treasury, based on what they're telling us, they are not playing around. I don't think the Fed is going to cut on March 19th. And because of the fact that the average correction lasts 115 days, I do think that it is time to be carefully selective here as it relates to stocks. I think that we will have time in this up and down business to be carefully selective with stocks that have cheap relative forward PEs compared to what they were trading at the last 5 years or so. I think that the time, once you hit a correction, you have to start thinking about what you are going to buy and how much. I don't think that you could just throw your entire money into random ticker symbols the way you could in 2023 or 2024. I think you have to be really selective based on valuation. The worse that the market is, the more valuations count. If you got anything out of this video, give it a big fat thumbs up. Let me know your thoughts down below. Do you think that we have more downside left in the market? Do you think that this is the bottom? Would love to hear from you as to why that is. What did you start nibbling on? Would love to hear from you as well. Sign up if you want to trade live with me every single day at market open. Also, make sure you sign up for a public account. I get the question a lot of times, what do you trade stocks or what do you trade options on? I trade options on public because they give you money back for your options trades. So not only are options trades free, they're commission free, but you get a cut of the order flow rebate. So this is how much I got paid from the order flow rebate so far this year. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace. Now, as I mentioned before, I've been using Public for my investing as well as my option swing trades. It's a regulated platform based here in the US. Now, we talked about commission-free trading and earning rebates for your stock and ETF options contracts trades, but they make it really easy to invest in bonds. It's not cumbersome. They actually have a bond account right now that pays 7%, giving you access to a portfolio of high yield and investment grade bonds. And if that's not enough, they have this AI assistant called Alpha. This is probably one of my favorite things on the app here. So I can ask it simple questions, right? Like, what is Tesla's free cash flows? And it tells me here that Tesla's free cash flow is reported at 2.742 billion, which represents a significant increase of 222.97% from previous figures. But I can ask it more complex questions like compare Nvidia and AMD. And it provides me a comparative analysis between Nvidia and AMD, going over its financials, its revenue, net income, EBITDA, free cash flow, gross profit margin, operating income, cash and equivalents, et cetera, et cetera. So it's very easy for you to get answers to questions before you make your investing and trading decisions. Use the link in the description below and get yourself a public account today.